Hey everyone, welcome. It is 1 p.m. on Thursday, April 25th. We just got the closing bell on what was a pretty exciting session. It definitely had range and motion and movement. So let's take a look at what that directionality was and if that changes what we see in this market. So if we look at the intraday, you can see that we gapped way down at the open. And we started out looking for direction, initially going down, and then we bounced upwards. And then we retested, and ever since then, it's been bullish. And we closed on a bullish sentiment. The good news is that we did bounce off of that 502.5 level. Then we came and retested it, and then we were able to go up and above it. So overall, on the direction of the day, bullish. People were obviously taking opportunity. This morning, I advise you guys not to try to bottom pick and go for quote unquote bargains. Obviously, if you day traded and look for bargains, then there is a pretty good chance that you found some and that you're looking pretty good for the day. But if we're looking on a longer term, it's not as certain. It's not so sure. The kind of good news is in the volatility, we peaked out at about 7 o'clock and it started to go down all the way from there. And you can see it's almost the mirror image of this SPY. And that is good that we're all the way down here at 1584, which means that our VIX is basically flat to yesterday. Actually a little bit lower than yesterday, where yesterday closed, which is kind of interesting because the SPY, even though it did recover, we're still significantly below the previous level. I guess not super significantly. We're down 40 basis points, but that's still beyond random. So we're down beyond random, but the VIX is actually lower. That gives us a little bit of bullish leaning, and it may mess around with our probabilities of actually getting that 10% correction. However, 10% correction is still the higher probability event. It's just that we may not go straight down. We might chop around a little bit before heading down there. Or if we chop around long enough, then we're going to have to modify our viewpoint again and say, okay, well, now we need to see, do we test down or do we test up? And if we test up, then does it pass or does it fail? If we test down, does it pass or does it fail? So the longer we stay in this range between the MA50 and the MA90, if we start chopping around in here, then our probabilities start to change. For now, it's still early, and for now, we're still looking at the going down to a 10% correction as the higher probability event. But after today's session, it's just a little bit less certain. It's just a little bit less probable than when we started the session. Today, you can see that we got basically capped out by the EMA 8. So we tried to rally to the EMA 8, got stopped there, pulled back a little bit. But overall, we were definitely higher on the day. We started all the way down at the MA90. So we'll have to see. It's probably going to be, so tomorrow we have PCE report. That's going to be very important. It could be a big determining report, just like the GDP was, and that will tell us if we're going to come down and challenge the MA90 again, or are we going to bust up above the EMA 8 and challenge the EMA 20. So that report is now become a little bit more important than it was before. And if we look over here, PCE, personal income outlays, that is going to be a Fed report. Now, this is not going to have an immediate effect. It's not going to meaningfully change the probability of a rate cut for May, which is in less than a week now, on May 1st. So that's maybe exactly a week from now. Generally Wednesday, so it should be 6 days from now, not 7 days from now. So the June may get affected though, and July may get affected by the PCE report. So it's a little bit further down the road, and so it might not have an immediate effect, or I should say it will have an immediate effect. It may not have a as magnified or as large of an immediate effect as the GDP report did. So in any case, we're going to look for that to tell us or to guide us on direction for the day. And what happens from there will sort of determine our new probabilities of breaking down to that -10 correction or coming back up and challenging the MA50. Right here, if we just look at candles, it can be a little confusing. It looks like we went down and we humped down like this. And so it was like, oh, we hit the EMA 20 and we pulled back and now we're bouncing back up. It's easy to think that. But if we look at a line chart, you can see that if we just go close to close, it's a little bit more clear. We came down, we touched that MA90, we bounced above the EMA 8, not quite to the EMA 20, and then we traded down back to the EMA 8. So that's the better way. This gives us a little bit clearer picture. The intraday stuff does matter because sometimes we touch for example, this doesn't look like it came nearly as close to the EMA 20 as it did when we had the high and the low available to us to see as well. So sometimes we do hit the levels that we're looking for intraday, not exactly on the closes. So we need to look at it both ways in order to get clarity. Okay, let's look at QQQ. QQQ, similar story, except not as strong, but it did lead the way up in this market. So money did start to go in and try to catch cheaper tech stocks, tech names. But as I said, that is more of retail trader behavior. It's not going to be indicative necessarily, or I'd be very surprised if institutions were doing that for two reasons. One, the psychology that I told you guys in the morning, that we cannot take a consumer mindset approach to the market. It's got to be the investor mindset. It's got to be an auction approach and not a convenience store or a shopping mall or any retail store type of mindset. I'll go into a little bit more detail after that in a little bit. But the other reason is we still got a lot of earnings coming up. And we have some big players. We still have a bunch of FANG stocks coming up. So if I look at tomorrow before market open, I've got ExxonMobil, that's a large energy stock, Chevron, large energy stock, AbbVie, large pharmaceutical stock. I've got another healthcare stock, Colgate-Palmolive, a large consumer staples stock, PSX, another energy stock. I have a whole bunch of energy stocks. I've got Charter, that is a communications stock. And then if I do today aftermarket, I've got Microsoft, I've got Google. Those are huge. Those are huge giants. Definitely part of the FANG stocks or the big seven. And huge market cap right here. I've got Intel. T-Mobile, I'm not as excited about, but I've got Intel. I've got some really KLAC semiconductors. We got some really huge names that are reporting immediately after the close today, maybe at this moment as we're speaking, and tomorrow morning, which means that your institutions are not going to make huge plays immediately before FANG earnings, and immediately before the top 10 largest market cap stocks report. They're just not going to do it. So a lot of this right here is going to be retail traders. I would bet like $10,000 on it. I would bet significant money on the fact that this movement right here was largely retail traders playing that convenience store mindset game, that consumer mind game of, oh, it's cheap, let's get it. It's cheap, let's get it. And that maybe it works out for them. Maybe it works out for them this time, but long term, that's going to burn them, and that's going to get them in a lot of trouble. It's going to blow up a lot of accounts. So imagine tomorrow you just bought a whole bunch of stocks right here. You guys like, hey, they're super cheap. And some of the ones that, like, you picked up Meta, because you thought Meta was super cheap. And look at that. It's just, it opened here, it ended here. You thought it was super cheap. And then Google misses tomorrow. Microsoft misses tomorrow. What do you think is going to happen to Meta? It's going to go gap right down again. So you may have thought that you caught a bargain right here, but in the end, you got burned pretty hard. So I'm not saying that that's going to happen. I'm just saying that the possibility of that happening is high. So that taking the approach of that quote unquote bargain is a gamble. It's not a strategy. So we don't want to play that game. I know that the institutions did not. If they did it with very small money, very tiny fractions of their portfolios. So a lot of this buying activity was actually by retail traders. I'm 100% sure of it. So that means for me that the overall, if I just look at the technicals, we should still continue to move downwards. Yes, we found some resistance, or sorry, support at this MA90. We found some support at that 500 level. We found some resistance at the EMA8, and we're sitting right at resistance. And tomorrow, all it takes is a little bit of bad news. The PCE is off, their earnings are off, and we just come right back down again. And one might argue, well, what if it's the other way, Ken? We got a really great PCE report and we got really great earnings. Fine. Where do we go? We go to the EMA 20. It's not that much to the upside, and the downside is all the way down, all the way down. So I'd rather take, if I'm going to take risk, I want the reward to risk ratio in my favor, not against me. So a little bit about the auction mindset, because I did have some questions. I did get some questions about it. So let's think most people operate their entire lives as a consumer, and they never think about being an investor. They outsource the investing to an investment professional. They don't actually manage their own investments. They don't look at them. They don't put thought in them. They don't think about them. So your habit from the moment that you're basically born and you're exposed to your parents, and your parents are consumers, and then you become a consumer, your entire life you're a consumer, and you have no area in your life where you act as anything other than a consumer. And then you go into a world like the financial markets, then your mindset and your approach and the way that you look at everything is also that of a consumer. You don't even know that you shouldn't be looking at the market as a consumer, because that's the only thing you know. Unless someone tells you and shows you and educates you how it's different than a consumer market. So in a consumer market, we look at really high prices and go, oh my God, that's expensive. I don't want to touch it. I'm not buying that. It's way too expensive. And we look at really low price things and we say, hey, that's really cheap. I'm going to buy that because that's a bargain. We love bargains, bargain hunters, deals. Everyone loves, as a consumer, everyone loves bargains and deals. And so you go into the markets looking for a bargain and you say, hey, look at this. Prices were up here. Now they're down here. That's a bargain. Let me buy it. And you buy it and it goes up and you feel good. And that might work. That might work at certain times in certain places. And certainly that would have worked in maybe kind of the last 6 months in the market and the S&P 500. Oh, look, it came down a little bit. It's a bargain. Let me buy it. Oh, look, it went way up. Oh, look, it came down. It's a bargain. Oh, it goes way up. I would have been really happy doing that. But if I said something like right here, oh, it's a bargain. It came down this much, it's a bargain. Well, it kept on going down. Well, is it a bargain now? Okay, maybe I feel good for a little bit, but a couple months later, if I held on to it, I'm not feeling so great. How about down here? It came from here down to here. That's a bargain, right? Well, a month later, we're all the way down here. So we can't take this bargain mindset to the consumer or the financial markets, because the financial markets are not a consumption. When I buy something, it's not eliminated. When I buy a car, it gets removed from the market. But when I buy a loaf of bread, I take it home and I eat it and it's gone forever. It never re-enters the market. A stock is not the same way. When I buy a stock, maybe it temporarily leaves the market because I save it in my brokerage account for a little while, but it's going to show up back in the market a little while later. If I'm a short-term trader, it's going to show up back in the market in a couple of days. If I'm a long-term trader or investor, it might not show up for 1 or 2 years or 10 years, but it's going to show up. It doesn't get consumed. It doesn't disappear. So I cannot treat this market the same way as I treat a consumer market because the goods get eliminated and removed and get replaced by something else or another copy of it later on in a consumer market. So what we have here is an auction. Every day, that's why it's called a bid and an ask. When I say, hey, there's a bid for 100 shares of the SPY, and then there's an ask for the share of the 100 shares. Everyone's auctioning and say, hey, I bid $100. And someone says, no, I'm going to ask $105. And as long as we have that bid ask, then nothing gets transacted. The difference between normal auctions that we're used to is that we have a market maker that ensures that there's constantly transactions. So the market maker will stand in between the 100 and the 105 and be like, all right, fine, I'll take yours. How about you sell at 104 and how about you buy at 102? And then the market maker will eat that $2 difference. So they lose money initially, but then they're going to seek to make it up in other transactions. And so sometimes it's the opposite. They make money. So they're every once in a while, for the sake of liquidity, they will take a little bit of a loss, but net, they're very, 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 very profitable. Investment banks all operate as market makers. So if I'm looking at a auction market, what's the difference? When I'm a consumer, I see high prices, I go, oh my God, that's expensive. Why would I buy that? If I see low prices, I go, hey, that's a bargain. Let me buy it. I'm super enthusiastic to buy it. But an auction is a little bit different. Auction, you have to feel there's also a sentiment to it. Maybe a high price is high, and you go, oh, I don't want that. But maybe that high price is also surrounded by a lot of excitement. So the classic, you've seen movies or TV shows or actual auctions where you have an announcer who's really enthusiastic. It's okay, who wants this cell phone for $1,000? Do I have a bid for $1,000? And then someone says $1,000, and then someone says, okay, how about $1,100? So do I have a bid for $1,100? Someone goes $1,100, and then as you see this item bid up, there's more and more energy. You go, and someone goes $1,200. Someone goes $1,500, $2,000, $3,000, and then people get really excited. That high price doesn't turn them off. It doesn't make them go, oh my God, that's so expensive. They actually get more and more excited. They go 3,000, 5,000, and then someone crazy goes $20,000, and everyone goes, oh, he can have it at $20,000. I don't want it at 20,000. In fact, if I had another phone, I'd sell him another one at $20, right? Because he goes, it's so crazy, it's so wildly high. Then finally, the frenzy stops, and they go, oh, you know what? Let's all sell it to him at $20. And so that's why high prices go higher in the financial markets. There's momentum, there's excitement, and people are getting on board. Just like in a real auction, people go crazy. 1,200, 1,500, 2,000, 3,000. They keep bidding it up until there's some crazy, stupid high price. And then the same thing on the way down. If you can imagine, you say, hey, look, Kane, Meta is super cheap this morning. I say, oh, is that so? Then I would go, hey, my auctioneer is saying, who wants a share of Meta at 420? And no one says yes. Crickets. And then he goes, okay, I guess I started the bidding too high. How about 400? Who's going to start the bidding at 400? Crickets. Okay, how about 375? Crickets. It's going to keep on going lower and lower and lower until the auctioneer says, how about $300? And it's just so stupidly low that someone's like, yeah, I'll take it at 300. And then that starts to transact. That's why lower prices can go lower in an auction. It is not the same thing as a retail store. Recently in the United States, there's a chain of stores called the 99-cent stores. They just declared bankruptcy and they're shutting down all their stores. They're on average, most of their items were being sold for 99 cents and they just can't keep it up in the today's inflationary environment. So they're shuttering all their stores. Their items are everything is 99 cents. Imagine that. Everything is 99 cents. And now they're shutting all their stores and then they say, okay, well, everything's 10% off because we need to eliminate all our inventory. 99 cents, 10% off, that's 90 cents. And you go, okay, everyone, I'm going to save 9 cents. Is that meaningful? Well, it was meaningful. A whole bunch of people were raiding those stores to get that 9 cents off. Because why? Because 90 cents is a bargain. 90 cents is an even bigger bargain. Well, guess what happened after a couple of weeks when the frenzy started to die down and they still had inventory? Well, okay, well, everything's for 80 cents now. Another wave of people rushing. And then after that wave, it was 60 cents, then 50 cents, then 40 cents. And I don't know where they stopped, but every time we went down, there was a bargain hunter looking for that price. And guess what? Even though this was a retail setting with a consumer mindset, prices still went lower. Just because it was a low price and a bargain doesn't mean that price couldn't get even lower. So sometimes even in a retail consumer mindset, the prices, if you're trying to catch a bargain, you still kind of got, if you take the perspective of the price, you can still get screwed. There still can be a lower price. The difference in a consumer market is that if normally bread is $5 and I bought it for $4, then I still got a deal because that bread, I still eat it. I still consume it. Just because the next person got it for $2 doesn't mean I didn't get value out of my bread. I didn't lose anything by buying it at $4. In an auction market, if I buy it at 4 and subsequently the price goes down to 2, I've lost money. So I cannot take the consumer mindset and the consumer approach into an auction market. It just won't work. We will lose money over the long run, and we won't lose money in every single incident, but we'll lose money a lot of the time. And we'll wonder why. It's like, oh, it was so cheap. It was a bargain. No, there's no such thing as a bargain in an auction. There's only the price at which people are willing to buy, or people get excited about buying, or people get excited about selling. Because that guy who yelled 20,000 for a phone, people got excited about selling to that guy. So we need to change our mindsets completely around the financial markets and just adopt that auction mindset and that investor mindset and not the consumer mindset. So hopefully that made sense. I spent a lot of time to explain that because it's critical. It's so critical. It's such a different mindset, such a different shift in perspective. And if you can't make it, you will keep on losing money in the markets. Okay. So this was not a bargain, even though, yes, today it looks like you would have made money. I showed you the example of Netflix also. If you did this and you bought it over the next couple of days, you would have looked like you made money. And if you made that money, you better have ran quickly because you would have come right back down. So right now we're chopping. And I told you guys this morning, until we stop chopping, we don't have a good projection or good probability of what direction this stock is actually going to go. And as long as we're chopping, we're losing money in time value. So there's no need to get in right at the drop. We want to get in after we're sure it stops dropping, just like COVID. Just like COVID. Okay. If I was a bargain hunter on COVID, is this cheap? How about the next day? Is that cheap? How about the next day? Is that cheap? Is this cheap? Is this cheap? Maybe I said, hey, it's cheap on the fifth day. Okay, great. It looks good for a few days. I better have sold. Otherwise, is this cheap? 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 You don't know. There's no such thing as cheap. That is a consumer mindset. There's no such thing as cheap. There's only where people are willing to transact, people are willing to buy, and where people get excited about buying and get excited about selling. Here we got excited about buying temporarily. Here we got excited about buying on a long-term basis. So that's a mind shift that is absolutely, absolutely critical uh, for for anyone who wants to put money in the markets. Otherwise, you're just flushing it down the toilet. You're just handing it. You're just giving it away to a professional trader. So I spent a lot of time talking about that. Let's see if there's anything else really to look at. I think basically the main idea right now is that this price held for now. Tomorrow we'll see if it'll continue to hold. If not, we could break down. Otherwise, we move up to the EMA 20 or MA 50, and currently our higher probability event is still towards the downside, but it's less probable than before. So it's a little bit more even. We were talking about 70, 80% chance earlier. Now we're probably looking at about a 60 to 65% chance. And so if we do happen to move upwards, we're going to look for resistance at the EMA 20 and the MA 50. We're sitting right at resistance right now, which is why we do have a higher probability of moving downwards. That's why it's not 50-50. Position yourself accordingly. Right now, there's a lot of risk in the market in either direction. So being hedged is nice. You make money a lot more slowly when you're hedged, but it's a lot safer. And if you're going to take a directional bias, I would say keep it small, and just a slight directional bias, or another way of saying that is small money in a directional move. Look for a high reward to risk ratio type of trades, and you're either choosing an extremely short time frame like a day trade, or you're looking at a minimum 1 to 2 week time frame. So I'll give you an example. Today I told you guys the example of ZTS, and I said, hey, we're sitting right at resistance, and we could say, hey, it's relatively strong to the market, so if the market moves up, we'll move up. Well, that's exactly what happened, but that was not the viewpoint that I chose. I said that was a completely valid viewpoint, and there was another completely valid viewpoint, and I was going to invest money based on that second completely valid viewpoint. The one that actually played out was this first one. But look, how far did it go up? Not that much. It just hit the highs of these right here. Not even all the way up to the EMA 20, whereas the S&P 500 made it halfway, a little more than halfway to the EMA. No, did it? Let me make sure I'm not saying something incorrect here. It poked its head above the EMA 8 and then stopped at the EMA 8. The ZTS is still slightly relatively strong versus the SPY. It's above the EMA 8, but it didn't go that far. And with the forces that we have, it could come back down. And so the question I have to ask myself is, was I looking at this for 1 or 2 days, in which case it moved against me, and I should probably be out? Or I can wait another 1 or 2 days because that's still within my time frame and see if it goes all the way to the EMA 20, and then I'm out because that was my predefined stop. Or do I say, do I give this thing 2 or 3 weeks to play out? And so what if it comes and touches the EMA 20? Because from there, the extremely high probable event is for it to come back down. And so, yeah, I lose money. It looks like on paper, I'm losing money for a week, but another week I recover, and another week I start making money. So I have to either take a longer time frame or a very, very, very short time frame. The normal like 1 week, 2 week swing trade time frames or 3 day, 4 day swing trade time frames, they're not going to work out for us very well at this particular moment in time. And so we have to choose our time frames very, very, very carefully as well. So we're going to be very careful about how we choose our investments. We're going to go in at small size, or we're going to be well hedged when we go into a position. And otherwise, we're just going to expect that volatility is going to continue. And for now, our probabilities are slightly in favor to the downside. Okay. So we'll leave it there for today. We've been talking for like half an hour. So I'll leave you guys for tonight. Have a wonderful evening, and I will see you in the morning.